Welcome back to Switzer on Australia's Business Channel. Earlier this year, Paul Rickard, former Comsec CEO, shared with us an income and a growth portfolio. So let's just see how they performed and get an understanding on what criteria was used to select the stocks. Paul, thanks for joining us on the program.
Thanks, Peter.
Now, you wrote it up in the Switzer Super Report. You came on the show. You shared it with our viewers here. So how did they go?
They've actually done very well, Peter, probably better than I expected, because we set it up more as a way to demonstration about how you create a portfolio.
Yeah. You weren't really trying to shoot the lights out. Safety was an important issue as well, wasn't it?
Absolutely. For our income portfolio, in fact, the main driver was yield,
yeah.
And we've done that. And in effect, if you look at against how it's gone against the market, it's performed about 4% better than the market.
Yeah.
And our growth portfolio, Peter, as I think there might be a chart in front of you.
Yeah, we've got a chart.
Is even better. It's more like about 6%. So year to date to the end of November, our growth portfolio is up by 25.6%. The ASX, when you add back the impact of dividends, look at the accumulation index, is up by 19.3%. So. Yeah. Pretty good.
Okay.
And,
pretty good. Well, I think most of us would be really happy to get results like this. Paul, I think that one of the things I want to ask you about is what was the criteria you used to select the stocks? And also, we'll talk about what you think might happen next year. It's always guesswork. But let's start with the income portfolio. What was the criteria that you used for that?
I'd say a couple of important ones. First of all, we've stayed largely in the top 100 companies, Peter. I mean, it's very hard to look at all 1,500, 1,600 companies, as you know. So we've stayed in the top 100.
But was there also a reason for the top 100? Apart from the looking, is there a confidence factor that you have?
For a yield portfolio, yes, because you have more confidence about the reliability of the dividend payment, because typically in the top 20 or 30 stocks, they've got a history of paying dividends. You can look at the management. They probably give you a better guide in terms of their forecast.
Yep.
So if you're actually, the objective is income, you can look at the history and actually put together the portfolio with greater confidence. So that's the second.
And how many stocks did you have in it?
Look, again, we've taken about between, my target's about 15 to 20.
Yeah.
And
why? Why do you want, say, 15 to 20?
And the logic for that is twofold. Firstly, if you look at all the studies on diversification, you start to get sort of most diversification occurring after about 10 stocks. So 8 to 10 is sort of where the number where you actually start to get, you see the real benefits of having a diversified mix of stocks. And there's lots of studies on this, Peter, that have looked at that. And Ron Bewley, one of your experts, our experts on the Switzer Super Report, he's done a lot of work on this. Yeah. But then on the other side, I can't manage more than about 25 stocks.
So it's conveniently.
So somewhere between about 15 and 20 is around about, for me, the ideal number. Look, if you have 30 or 40 stocks in your portfolio, it's too many to keep track of, I find. Also,
Paul, if you have 20 stocks, it means that if one stock has a really bad year, and like AMP was a classic bad year for price, not for dividend, but for price, well, it doesn't knock your whole portfolio around because you've only got a 5% exposure.
Look, a bit more scientific than that, Peter, because we actually may take a bit more than that, but you're right. I mean, so
I know the index weight is important too.
And then the final step is actually to look, before we even get to the stocks, is to look at our position in the different sectors. And so we've taken what I'd describe as both overweight, index weight and underweight positions in the various sectors that make up the market, and that should be on the chart you can see in front of the screen now.
Okay, let's try and get that chart up. But give us an example of a stock that you went over index weight and why you did it.
Well, let me start with the obvious. We've been overweight on an index basis in the financial stocks. That's the major banks plus, Bank of Queensland and the AMPs. Yeah. For a dividend portfolio, because at the start of the year, the franked dividends were almost 6%.
Yeah, the share price was nice and low.
The share price was nice and low. Yeah. We've seen really good predictability. Apart from one down year in 2008, most of those major stocks have a history of increasing their dividends every year. Yeah. So a lot of confidence about that. Index weight would suggest that a portfolio you might have about 38% in financials. We've gone closer towards 50%, so that's the first thing. Okay. The same with telecommunications, which is dominated by Telstra, 28 cents fully franked dividend yield. Start of the year was under $4, 5.6% fully franked. Gross that up, and that's pretty tax effective.
Okay. So obviously, listeners will be saying, well, Paul's judgment call that financials and Telstra were going to have a good year, does that mean maybe next year you might lighten off on these companies, or will you hold them because it's an income portfolio.
But I think for the income side, I'd take sort of by and large the same position, although I'm a bit like you. I tend to think the banks have had a pretty good run, and so has Telstra. So I'd certainly be index weight. How overweight I'm going to be is probably a little bit different. So 2014 versus 2013, my guess is I'm going to be less overweight in some of the sort of key sort of yield-based sectors, and in some of the sectors that I think where growth is more likely, such as some of the industrial companies, I'd be looking at some of those companies that pay reasonable dividends. So I get a bit of growth and get the dividend upside.
Let's go to your growth portfolio now, because where do you get your best returns on the growth?
Well, again, from perhaps not where I expected, I took an overweight positions in materials, and that's the BHP and Rios and some of the other stocks, and that hasn't done too well.
No. So it went down, then went up.
It went down.
Over a year basis, it wasn't great.
Over the year hasn't been too good, and that's where I'll be next year. But
you'll stick to the materials.
But where I've done better in some of the energy stocks, also things like consumer discretionary with a stock like Crown Casino. And also some of the healthcare stocks, because I'm overweight in healthcare and CSL and Ramsay.
Ramsay keeps defying the PE, doesn't it? It just keeps going up.
It keeps going up. If you want to look at a share chart of a stock over 10 or 15 years, have a look at Ramsay Healthcare. Yeah,
most definitely. So next year, are you going to, in your growth stock portfolio, are you going to stick to big companies, or are you going to try and get yourself a bit of exposure to the smaller companies that have had a rough time over the last year or so?
Look, I think for the portfolio that we try to construct, which is a bit like what you and I might try to do at home, we try to keep it reasonably simple.
It's basically self-managed super fund people who are constructing their own portfolio.
And basically look at the stocks that they're more likely to want to be interested in, which are going to be the big stocks.
Yeah.
Personally, I think there's going to be a lot of growth in the smaller stocks, and I think that's where you need maybe an expert or other ways to do it. So, look, I'm going to look at some smaller companies, but not as part of this portfolio, because I think you've got to put yourself in the same sort of seat as a lot of the people at home.
Yeah.
But I think there are within some companies and some sectors those that have exposure to a lower currency, those that are definitely more cyclical in nature. I think the resources stocks, the BHP and Rios, are going to do pretty well in 2014. So I think my overweight call of materials may finally pay some dividends next year.
When will you actually reset the portfolio for next year?
I'm going to set it back at the start of the year, just because it keeps it nice and simple. It's easy to track. Everyone can look at it.
So when we come back from Christmas holidays, you should be able to tell us what you're going for.
Yeah, and we'll publish it exclusively in the Switzer Super Report in early January. There won't be huge changes, but there'll be some changes.
And remember, if you don't do well, I'm going to have to bring you on the program and you have to explain why you didn't do well as well.
That's the downside.
That's the downside.
As we know, you sometimes get things wrong, and hopefully we get things right more often than we get things wrong.
Okay, and if someone wants to catch up on what you've done, a couple of weeks ago in the Switzer Super Report, you actually explained...
Every month I cover what's happened and look at what's in the market, and look at what might happen the next month as well.
All right, Paul, thanks for joining us in the program.
Thanks, Peter. It's been a pleasure.
Okay, so after break, we'll talk to a rival of a recently listed freelancer.com and see what their plans are for the Aussie workforce.